Today we're going to talk about the lease questions. So we're going to compare the options of buying the machine versus the option of lease only. So we have this Exomax company needs a new copy machine, and the cost is $10,000. If you purchase, you initially spend $10,000. The machine follows straight line depreciation over 5 years to 0. And the impact of the machine on the operating cost is saving $6,000 in electricity bills for the next 5 years. Another option is lease. In the leasing terms, every year lease payment is $2,500. It's 5 years. Company in the tax rate of 34%, and the cost of borrowing is 7.57575. So how do we compare which one's better? So let's take a look at the breakdown of the cash flow activity. So I put side by top next to each other. The top one is purchase option, buy this machine. The bottom's lease only. So it's a 5-year project. At year 0, if you buy, you spend $10,000 for the machine cost. Okay. So due to the machine, we do have annual depreciation tax, and the depreciation tax benefit. So how we get a 680? The machine is 10,000 over 5 years, and the tax is 34%. So this will give us the depreciation tax shield is 680. Now using this machine will save our operating cost by 6,000 and adjust for tax effect. So after-tax operating saving is 3,960 every single year. So now focus on the lease options. The lease payment is 2,500 every single year for year 1 till year 5. Lease payment is type of expenses, so we're going to subtract from our taxable income. So this will save our some tax bill. So how much is the tax benefit of the lease payment? So we use 22,500 times 34%. So the lease payment will save us a $50 tax payment every single year. The impact on the operating savings are the same. It's also the same of 3,960. So these are the two separate options, purchase only or lease only. So we want to compare which one will cost less money. So our focus is on buy versus lease. So we want to use buy as our benchmark. We want to compare lease option versus buy option. So if you compare year-to-year cash flow, for the lease option compared to buy, you don't have to pay the 10,000 at time 0 for the machine cost. So we saved 10,000 at year 0, right? Compared to the buy option, where we have to spend 10,000 immediately. Now from year 1 to year 5, the saving on the operating costs, they are the same. So there's no change in both cases. We do have to pay lease payment. Combine these together, we can call this after-tax lease payment. So this is the payment that we pay from year 1 to year 5. We also lost the depreciation tax shield because we did not buy the machine, so we cannot claim depreciation expenses. So we also lost depreciation tax shield. So now let's look at this comparison. So remember, this is not a single case. We are comparing lease versus our benchmark buy option. So as you see, we saved the machine cost, we lost the depreciation tax shield, we also have to pay after-tax lease payment. So this option, lease minus buy option, we give it a term, it's called net advantage of lease. NAL, net advantage of lease option, equal to cost of the machine and minus the after-tax lease payment and the depreciation tax benefit. So in the real world, lease payment, just like depreciations, we tend to discount at riskless cost. So we tend to use after-tax cost interest to discount either depreciation or lease payment. So in this case, the cost of debt is 7.57575. So after tax adjustment, so we're going to use this 5% as our discount rate for the lease payment. So the machine cost is 10,000. That is something we saved. Both the after tax lease payment and the depreciation together is 2,330. So we can use cash flow keys or annuity factor to find the net present value of this question. So we found out net advantage of leasing is negative 87.68, which is a lease is not as good as buy. So in this case, buy is better call option. So this is the part negative means the lease actually cost more money. So compared to buy option, lease will produce less cash flow. So we will go with buy option. I'm going to also talk about sometime we want to know how to beat our prices, how to set the break-even payment. So let's find out what's the bottom line. What is break-even lease payment option? So to make the net advantage of leasing equal to 0, so we are able to find out what kind of lease payment will give us the break-even, which means we are indifferent between leasing versus the buying option. So follow the previous example, cost machine 10,000, we put the lease payment with L, and we also have the after-tax, we also have a depreciation tax shield. Again, we use 5-year annuity term at 5%. So set net advantage of leasing equal to 0, we can figure out the minimal breakdown lease payment is $2,469. So what is the maximum lease payment that the company should? So in the worst case, for example, you are not classified as operating lease and you are classified as a capital lease. So where you will lost all the benefit in the tax. Okay, so you lost a tax benefit from depreciation, you have to also pay the cost of borrowing, not no tax benefit. So in this case, so we will still set the break even. However, remember there's no depreciation tax shield, so only lease payment. We also have to use a higher discount rate. So this gives us the maximum lease is, so we got maximum lease payment. So this is quite extreme cases where we lost all the tax benefit. So we have to pay high discount rate. We have no depreciation tax shield. Let's look at this example. Lease versus buy. So this company is buying a machine, cost $480,000. Straight line depreciation over 5 years, then will be worthless. Lease the machine option is $170,000 every year. And the cost of debt is 9%, tax 35%. So which option better, buy or versus lease? what is the minimum lease payment? What's the maximum lease payment? Okay, so first let's figure out the depreciation tax shield and after-tax lease payment. So the machine cost is 480,000. We have 5-year term, tax 35. So the depreciation tax shield is 33,600. After-tax lease payment is lease payment times 1 minus tax rate. So it's 84,500. So the total cash flow in the net advantage of lease is 118,100 outflow. So the discount rate we use after tax cost of debt 9% times 1 minus 35%. So NAL is cost of machine, which is we saved, and the annual total cash flow spending. Then we use a 5-year annuity factor. So we got NAL is negative amount. So which option is better? Lease versus buy, which one better? Buy is better. Right. Now we're going to figure it out. To do the minimum lease payment, again we set NAL, net advantage of leasing, equal to 0, and follow the previous same equation set up. The only difference is we don't know the minimum lease payment. Right? Then we can back out, find out the lease payment is 122,901. The maximum lease payment, where we lost all the advantage of the tax benefit. There's no depreciation tax shield. There's a higher cost of debt. So this will give us the maximum lease payment. So that's about the example of NAL, lease versus buy options, how we solve that.